buy outlook for the currency upwards quite a bit, quite drastically. And given the unpredictability around this area, have you had to build in a bigger sort of margin for wiggle room here?
Well, it is a very difficult area for forecasters around New Zealand and around the world at the moment. We're all finding that our forecasts we have had to change them as a result of the higher than expected New Zealand dollar or lower than expected US dollar. And we all know that we don't have a high degree of precision around those. In fact, in the short term, we have very little forecasting ability there. That's accepted amongst economic forecasters. So there is a high degree of uncertainty as to where that New Zealand dollar, US dollar cross goes. Is anything either of you would wish to add to that? No. Thanks, guys.
Yeah, Dr. Bollard, just how worried are you about the effect of the high dollar on prospects for an export-led recovery?
We have in this forecast, as I've just said, had to contend with a higher than expected level of the New Zealand US dollar cross rate, but at the same time we have also have a slightly stronger export picture than we expected. Actually, both export volumes have been stronger and export prices have been a bit stronger as well. The latter is very much a consequence of a stronger international commodity price story. We've been very pleased to observe the evidence of the dairy price bottoming out and showing some growth after two monthly auctions with very significant increases in there. We believe that's enough evidence to say that the longer-term price looks healthier. That does have quite a significant effect and actually helps balance out that higher New Zealand US dollar cross rate.
But at what level is it being completely offset, though?
Well, I mean, I can't answer that precisely. There's a lot of ways that the exchange rate impacts the current account through different classes of export, depending on how elastic they are, imports, and of course the net investment income balance, which in New Zealand is a pretty important part of the current account. But we would be disappointed if we saw this trend continuing, because there is no doubt that it will cut into New Zealand export returns, and it puts at risk the recovery that we're seeing in our current account deficit. Already we're forecasting a deficit that's gone from 8% through 7% and forecast to go to about 6%, but even on our forecasts in here, it starts to retract a little bit, and that is an undesirable thing for us in this environment.
Dr. Bollard, just on the markets, you may recall David Longy once called them demented reef fish. It sounds as though you agree with that view.
Well, he may very well have said that, but we wouldn't actually put it quite in those terms. We do get some information out of them.
Dr. Bollard, the recent rise in house prices, does that give you any concern, and do you see that as a bit of a false dawn for the market, given your earlier forecasts on prices to fall?
John, would you like to handle that?
Yeah, I mean, we've seen house prices fall, so peak to trough about 10 or 11%. I think 3 months ago we were expecting about 16%. What we've seen recently and what we expect over the next 3 months is a little bit of retracement of that fall, and looking for some stability in house prices. One of the key factors behind the tightness in the housing market is just a limited number of listings in the housing market, and there's a good chance over the spring that may well change.
Dr. Bollard, you've warned about the imbalances in the economy. What can you do about them apart from putting up the official cash rate?
Well, the imbalances we're talking about are basically domestic external imbalances, and what we're concerned to see, or concerned not to see, is that a household sector newly invigorated with confidence ploughs back into housing in a major sort of way. We don't think that's going to happen, but the consequence of that happening could be a move back into debt, increased household consumption, and very importantly, reduction in household savings. to say we don't expect to see that happening, but we'll be watching that part of it very closely. I think New Zealanders have been through this period and have realised that house prices don't keep going up forever, that they do need to look at a range of different ways of building up their own balance sheets, that they do need to think more seriously about savings. And of course that's in a context where the New Zealand government at the minute is unable to save as it has traditionally done. So New Zealanders should be thinking about saving themselves to ensure that our national investment and balance doesn't get out of proportion.
Could you consider changing, for example, capital adequacy rules to encourage the banks to lend less into housing and farming?
Well, in principle, we can consider that. In fact, we have considered that in the past, provided it is done for the purposes of that part of the Reserve Bank Act, which is to promote soundness and efficiency in the financial system. Now, we did look at doing that a couple of years ago as we started to see this housing bubble build up. The fact is that when you look at that in detail and simulate what it might actually require, it tends to sometimes require quite big changes in capital, and it doesn't always impact the particular banks that you would expect or hope that it might impact. And actually we ended up from that concluding that capital adequacy ratios as a short-term stabilisation tool make the official cash rate look very scientific and very analytical and very sophisticated.
In the statement, there's some comments on the New Zealand dollar and how it's moving. It seems more with the S&P 500 than it is with local interest rates. Could you have put up interest rates and not increase the New Zealand dollar?
We didn't consider that option, although I believe that Israel tried that one recently without too much effect.
Dr. Bollard, in the box on the New Zealand dollar, you talk about it being the rise being unjustified and at odds with recent developments in the economy. At what point does it meet the parameters where the bank intervenes in the currency?
We don't discuss publicly our intervention policies or practices.
Broadly speaking, what are the sort of the things where you were, well, the parameters that you would intervene in terms of,
I think said, we don't
extreme
discuss
and unjustified, I think is the term that you've used in the past.
We don't discuss that publicly for obvious reasons.
Just one other question about it. Have you considered that the New Zealand dollar, I mean, we seem to be going through this repeated cycle of the New Zealand dollar rising and inhibiting economic recovery. Have you considered whether having a free floating exchange rate is the best option for New Zealand?
We always look at options. We've had background work on these things. If you look around the world, it's very difficult to see better institutional arrangements that might work for a country like New Zealand. So we think New Zealand's options are somewhat limited like that, as are many other countries at the minute. Many other countries are going through some pressure on this. But I don't want to be too hand-wringing about the question of the New Zealand dollar. Actually, recently it has been tracking up our commodity price story in a way that's not necessarily that far from fundamentals.
Dr. Bullard, what's the thinking behind, I see the 90-day interest rate projection there, it's been adjusted from the June monetary policy statement to sort of a steeper sort of increase in 2011. What's the thinking behind that?
Well, look, I mean, that's right. You can see there on the 90-day interest rate track. I think